The S&P 500 just hit another all-time high, but a specific slice of the market has been dead money for over a decade, trading at prices straight out of 2011. It seems completely wrong on paper. The big stock indexes keep climbing to new records, while millions of everyday investors watch an entire sector sit totally frozen in time. That massive gap is not a mistake, and it is definitely not going to last forever. By the end of this video, you will understand the exact mechanism that turns boring and ignored assets into market-beating winners, and how to position yourself before the rest of Wall Street wakes up. I track these overlooked shifts every single month, so hit subscribe right now so you do not miss the next one. When you look past the noise, the stock market is just a giant machine driven by simple supply, demand, and patience. Most people buy whatever is flashing green on their phone screens today. They jump in at the top because it feels safe, completely ignoring the quiet corners where real value sits completely untouched. But the math always wins in the end. When an asset trades below its actual worth for this long, it builds up energy like a coiled spring. You do not need to guess when it will snap. You just need to know how the pressure builds, why the crowd missed it, and where to put your money before the narrative shifts overnight. Let us look at the blunt numbers and see what is really going on beneath the surface. Think about walking down a busy street looking for a place to eat dinner. You see a trendy restaurant with a line wrapped twice around the block. People are waiting 2 hours just to get a table, not because the food is twice as good, but because everyone else is standing there. Right next door, there is a quiet little diner with an empty dining room. The chef inside is cooking incredible, high-quality meals, but nobody looks through the window because there is no crowd to draw them in. For a long time, the crowded spot gets all the hype and charges double the price, while the empty place sits completely ignored. That is exactly how the stock market operates. Popular sectors get all the attention, pushing prices up simply because everyone is piling into the same room. Meanwhile, great assets sit in the dark, trading at dirt-cheap discounts. But price and actual value are two very different things. A high price tag does not mean something is smart, and a low price tag does not mean something is broken. Eventually, the crowded restaurant gets too expensive, the service slows down, and people start looking around for better options. They look next door, notice the empty tables, and realize they can get a better meal for half the cost. Almost overnight, the crowd shifts. In finance, we call this natural shift sector rotation, or mean reversion. It is a long name for a very simple habit. Money always leaves overpaid hype to go find underpriced value. Market cycles are constantly swinging back and forth like a heavy pendulum. When a sector gets left behind for years, the money does not disappear forever. It just sits on the sidelines, waiting for the high-flying stocks to get too expensive. When big institutional investors decide it is time to take their profits off the table, they do not just throw that cash into a bank account. They look for the assets that have been left for dead, because that is where the highest potential returns are hiding. That simple back-and-forth movement is the exact engine that turns forgotten assets into tomorrow's biggest gainers. Once you learn to look for the empty restaurant instead of joining the longest line, you stop chasing yesterday's news and start building real wealth. This mispricing did not happen by accident. It was created by a specific chain of events that quietly knocked down one domino after another. When you look back over the last decade, 4 clear moments explain why this entire sector got left behind, and each one comes with a direct number attached. First, back in 2014, global energy markets suffered a massive supply shock that cut crude oil prices by over 50%. When oil dropped from over $100 a barrel down into the 40s, Wall Street completely lost interest. Investors panicked and pulled hundreds of billions of dollars out of traditional resource funds. That sudden exit created an initial wave of forced selling, pushing asset prices down to levels not seen in years. Second, in 2018, the Federal Reserve pushed through 4 separate interest rate hikes in a single year. Raising interest rates makes borrowing money much more expensive for capital-heavy businesses like pipelines, factories, and utility networks. While high-flying tech companies barely felt the squeeze, dividend-paying sectors saw their profit margins tighten almost overnight. Conservative investors left these funds and moved their cash straight into safer, high-yield savings accounts. Third, by 2020, massive index funds executed a major rebalancing. Sector weightings inside the broader market indices were systematically altered, cutting this group down to less than 3% of the entire S&P 500, down from over 12% just a decade earlier. Because passive index funds are legally forced to match these exact percentages, millions of automatic retirement contributions were instantly redirected away from these companies. The sector was essentially put on a strict financial diet, stripped of autopilot buying power. Fourth, during the huge market run in 2023, institutional investors pulled over $15 billion out of value-based sector ETFs. They recycled that capital straight into mega-cap artificial intelligence stocks to chase quick momentum. It was a classic flight to what felt popular and exciting. When you link these 4 dates together, you see the full picture. It was not a single crash that broke this market. It was a decade-long sequence of forced selling, rising rates, index changes, and trend chasing. That chain of dominoes created a giant disconnect between current stock prices and actual corporate earnings, giving us the massive setup we see sitting right in front of us today. To see how fast this setup can turn around, you only have to look at what happened to regional banks back in 2023. When a couple of mid-sized banks failed, terrified investors threw the entire group into the trash, assuming every local lender was about to collapse. The SPDR S&P Region Banking ETF plummeted, leaving dozens of rock-solid institutions trading at a ridiculous price-to-earnings ratio under 7. Big Wall Street firms stayed away because the headlines were scary, but the underlying numbers told a completely different story. Once the panic cleared and traders realized the sound businesses were still printing money, money rushed back in, driving a rapid 40% rally from the lows and proving that fear always creates cheap entry points. A similar story played out with the entire country of Japan just a few years ago. For nearly 3 decades, global investors treated the Japanese stock market like a forgotten graveyard, convinced it would never grow again. Nobody was buying, and funds pulled out billions of dollars year after year. But while the crowd looked away, Japanese companies quietly cleaned up their balance sheets, boosted profits, and started paying higher dividends to shareholders. When Warren Buffett publicly stepped in and bought major stakes, the rest of the market suddenly snapped to attention, triggering a massive wave of buying that launched the Nikkei 225 past 40,000 to crush its previous 34-year high. Finally, take a look at what happened with traditional energy stocks right after the global shutdowns in 2020. Crude oil futures briefly crashed below $0, and Wall Street declared fossil fuels completely dead, dumping energy company shares at historical lows. People treated these businesses like buggy whip manufacturers that would never make another dime. Yet, over the next 2 years, the Energy Select Sector SPDR fund exploded upward, handing patient investors a massive return of over 200% as real-world demand snapped back. Each of these cases proves the exact same point. When the market completely abandons an asset, it creates the precise conditions for the biggest gains you will ever see. Let us bring all of this down to real life with a quick example. Meet Sarah. She is 34 years old, lives in Austin, and earns a solid salary of $68,000 a year. Like millions of hardworking people, Sarah wants to make smart moves with her cash. She puts a chunk of her paycheck into her employer's 401k and leaves the rest sitting in a standard bank savings account. She figures she is playing it safe, but the default choices she picked are quietly costing her serious money every single year. Her savings account pays a tiny interest rate, earning her just a few bucks a month. Meanwhile, her default 401k target date fund automatically dumps most of her investment into the same mega-cap stocks that everyone else is chasing at record high prices. By completely ignoring this forgotten, undervalued asset class, Sarah is missing out on both high dividend payouts and major growth potential. When you break down the blunt math, the dollar gap is massive. On her salary, saving just 10% of her income means she invests $6,800 a year. Sitting in default funds and low-yield cash, that money might grow by 4 or 5%, leaving her with around $300 in growth. But if she shifts a portion of that capital into undervalued sectors, returning a historic average of 9 to 11% through price gains and high dividends, that same yearly savings produces nearly $750 in returns. Over a single year, a gap of $450 might not sound life-changing, but extend that timeline out over 10 years, and compound growth turns that gap into over $25,000 of missed wealth. That is real money that could pay off debts, fund a home down payment, or build a real cushion for early retirement. Sarah's not doing anything wrong, but she is letting her money sit on autopilot in overused, expensive assets. You do not need a fancy finance degree or a huge bank account to fix this. You just need to stop putting all your cash into the crowded room and start allocating a piece of your paycheck where the real value is sitting. That small shift is how everyday workers turn a regular salary into lasting financial security. Now, if this setup is so obvious and the math is this clear, you have to ask a fair question. Why isn't everyone talking about it? If there is so much money to be made, why isn't your favorite news station or financial app shouting this from the rooftops every single day? The answer comes down to three very real traps: media incentives, recency bias, and professional career risk. First, big financial news networks are in the business of selling attention, not building your long-term wealth. Boring, undervalued assets that move slowly do not generate clicks or big headlines. A solid business trading at a discount is quiet. It is boring. High-flying tech stocks making huge daily moves get people to click on articles, watch TV ads, and check their phones every 10 minutes. The media talks about what is popular today because drama gets views, even if chasing that drama hurts your bank account. Second, most investors suffer from recency bias. This is a simple psychological trick where our brains assume whatever happened over the last few years will just keep happening forever. If shiny growth stocks went up for 3 years in a row, people assume they will go up for the next 10. Humans naturally hate buying things that have been flat or dropping, even when those exact items are on sale for rock-bottom prices. We feel safe buying what is popular, even though buying at the top is the worst move you can make. Third, professional Wall Street fund managers face massive career risk. A fund manager who buys an unpopular, expensive stock like everyone else will not get fired if it drops, because every other manager lost money too. They get to hide in the crowd. But if a manager takes a risk, buys an ignored value asset, and it takes 2 years to turn around, anxious clients will cancel their accounts and fire them. For most pros, it is safer for their paycheck to be wrong with the crowd than to be right all by themselves. When you put those three things together, you realize why the big institutions leave these opportunities on the table for so long. The news avoids it, regular investors are scared of it, and fund managers are too nervous to buy it. That exact silence is your biggest advantage. By understanding these incentives, you can step around the noise and position your money before the crowd inevitably rushes back in. Now that you see where the value is hiding, you need a clear, simple plan to put this knowledge to work. You do not need to overcomplicate this process or spend hours staring at stock charts every single day. Here are 4 practical steps you can take right now to position your money safely and build real long-term wealth. First, do your homework using low-cost ETF research tools. Instead of trying to pick individual winning companies, search for broad sector funds that track undervalued areas of the market. Look up tickers like XLE for energy, XLU for utilities, or SCHD for high dividend value stocks. Use free financial websites to check 2 main numbers: the price-to-earnings ratio, which should ideally be well below the S&P 500 average, and the expense ratio, which should stay under 0.20%, so fees do not eat your gains. Next, pick the right account type to maximize your tax savings. If your goal is long-term growth for retirement, buy these income-generating assets inside a Roth IRA. Because these undervalued funds often pay higher dividends, holding them in a Roth IRA means every single dollar of growth and dividend income comes out completely tax-free in retirement. If you already maxed out your IRA, use a standard taxable brokerage account, but prioritize funds with lower turnover to keep tax drag low. Third, start a steady dollar-cost averaging plan. Do not try to time the market or dump all your cash in on a single day. Set up an automatic transfer of $50 a week through beginner-friendly platforms like Fidelity, Schwab, or Robinhood. Automated buying removes emotion from the equation, ensuring you buy more shares when prices are low and fewer shares when prices creep back up. Also, set a simple rebalancing rule to lock in your profits. Pick a specific date on the calendar once or twice a year, like your birthday or New Year's Day, to check on your portfolio. If your undervalued sector rallies hard and grows to make up more than 15 or 20% of your total account, sell a small portion to take your profits off the table. Take those gains and move them back into your main index funds or another neglected sector. This simple rule forces you to automatically sell high and buy low without second-guessing yourself. Before you take a single dollar of your hard-earned money and deploy it, we need to have an honest talk about the risks. This strategy is completely real, and the math behind it is rock solid. But I want to make one thing crystal clear. This is not a get-rich-quick scheme. If you are looking to double your money by next Friday or buy a fancy sports car next month, this strategy will disappoint you. Investing in ignored, undervalued assets requires patience that most people simply do not have. When an asset has been sitting dead in the water for years, it does not magically turn around overnight just because you decided to buy it. Wall Street takes time to change its mind. You might hold these funds for 1 year, 2 years, or even longer while the rest of the market keeps running after shiny object stocks. There will be days when it feels like nothing is happening, and you will be tempted to sell out of boredom. You also have to accept that there are no absolute guarantees in the financial world. A cheap stock can stay cheap longer than you expect, and unexpected economic events can delay a recovery. Company profits can drop, interest rates can stay higher for longer, or global events can shift demand. That is why you should never bet your entire life savings on a single trade or chase an asset just because it looks ridiculously cheap. The timeline for true mean reversion is measured in years, not months. You are planting seeds in quiet, neglected soil, and you have to give them time to grow. But for patient investors who understand the process, that waiting period is where the real edge lives. While the crowd panics over daily noise and trades in and out of hot trends, you sit back, collect your dividend payments, and let the long-term math do the heavy lifting. Protecting your downside and keeping your expectations grounded is how you stay in the game long enough to actually win. When you align your portfolio with realistic timelines and blunt data instead of wild hype, you stop gambling and start building sustainable wealth that lasts for generations. Now that you have the math, the history, and the exact steps right in front of you, the only thing standing between you and a better portfolio is action. Most people talk themselves out of taking action by leaning on the exact same set of excuses. So let us knock those down right now. First, if you think you do not have enough money to start, remember that modern platforms let you buy fractional shares for as little as $5. You do not need a massive bankroll. You just need to start the habit. Second, if you are telling yourself you will wait for a bigger market dip to buy, you are falling into a classic timing trap. The sector we talked about today is already sitting at decade-low prices, while everything else is at record highs. Waiting for a better entry point is just procrastination in disguise. Third, if you feel like you do not fully understand exchange-traded funds, think of an ETF as a pre-packaged basket of regular companies. Buying one single share of an ETF instantly buys you tiny pieces of dozens of top businesses, protecting you from single stock risk without any complicated setup. At the end of the day, the choice is entirely yours. You can keep doing what most people do, buying whatever is trending on social media, chasing high-priced hype at the top, and wondering why your wealth is not growing. Or you can take control, follow the blunt numbers, and position your money where real value is sitting quietly in the dark. The math does not lie, but it only works if you use it. Nothing in this video is personal financial advice, and you should always do your own research before investing your money. If you found this breakdown useful, hit the like button so more people can see it. Leave a comment below with the sector you think is most undervalued right now, and subscribe to the channel. I track these overlooked market shifts every month so you can stay ahead of the crowd. Thank you for watching, and I will see you in the next video.